You are listening to chartingwealth.com for Monday, the 27th of July, 2015. We start with IYY as usual. We have three down candles as the week ended on Friday, the 24th. That wrapped up the third consecutive two-day down candle. Now, when we start talking about candlesticks, those of you who are just tuning in for the first time or one of the first times, please look up candlesticks. You can go to our website, chartingwealth.com. You can look up in Investopedia. Just Google it. Japanese candlesticks. You'll understand what we're talking about. We have three red down candles. In fact, the candle as it ended on Friday was down substantially more than it ended up. What happened was the market opened. Now this is again a two-day candle, so over the course of those 2 days, the market opened at a level and was driven down about twice as far as it ended up, which meant that the bears drug the market down substantially. The bulls were able to push it up to where it ended with a wick just as long as the down candle. So we've got substantial downward pressure on the market. The derivative oscillator, which we have depicted on our chart as a light green box, it has lost a lot of its energy. And we see that the two-day trend line, the two-day MACD is also just about to cross going down. It had only rotated over going up around the 15th of July and is now getting close to crossing over going down when the market ended on that two-day candle on Friday. So let's drop back and see what happened intraday. We can do that with our 4-hour or half-day chart. We see that the market opened a little bit higher than it had closed the day before and drove down during the morning and then drove down even further during the afternoon, actually piercing the bottom shadow or wick on the red candle, actually pierced the Bollinger Band. And again, our Bollinger Bands on our charts are depicted by a blue dash, and the area where most of the movement occurs is within a shaded blue area. We crossed over going down on the 22nd, right as the market opened on the 22nd of July on the 4-hour chart, and substantial down movement. Now, we don't yet in the total chart have a crossover, but we're very close to a crossover on our 2-day chart. So for the record, we still don't have a crossover taking us out of the up move, but we're getting awfully close to that. What would keep us from looking at entering a down move? Well, we want to see what happens as the market opens on Monday, what occurs when the next candle closes, and whether or not we have a confirmed down move or if it's going to bounce back up again. When did it do that last? Well, if we go back to the 23rd of June, we can see where the market appeared to be moving up substantially, hit the crossing point of the MACD, and then rolled back over on the next candle and powered down even further. So let's keep an eye. This is a crazy time of year. Sell in May and go away. We've been saying since May. Why? A lot of volumes out of the market. A lot of people sell in May and go away. Don't have typically the volume in the summertime trading zone that you typically see in the fall and winter trading zone, which means that the market can be a little more herky-jerky up and down. So we will pay close attention to that. Now, let's drop back and look at SPY. What is SPY? Well, that's the Standard & Poor 500. We don't have three down candles like we do in the total market. What we actually have is two down candles, but we can redraw our trend line. For those of you watching on video, that is what I'm doing right now. We just redrew it. It's that easy to do on freestockcharts.com. If you don't have it, you need it. You can go to our website, chartingwealth.com, sign up for our newsletter, and we will actually send you the layout that we use at freestockcharts.com. All you got to do is sign up for our newsletter, and you'll get that. So let us hear from you. What do we see on the SPY, the Standard & Poor 500? Again, we see a converging, not a crossover yet, of the MACD and the red signal line. When that crosses over, we'll have a confirmed down move if that happens. I've already given you the what ifs. We also see the derivative oscillators falling out, and we have two candles moving down, and again, substantial downward pressure pushed up by the bulls. And when I say bulls and bears, remember, the bears are pessimistic, drive the market down. The bulls are optimistic and drive the market up. And when you see a long wick at the bottom, that means that the bears had a lot of power to drive it down, but the bulls had enough power to drive it back up to where the red candle ended. But it is a down day, a day for the bears. Now let's drop back to the 4-hour chart, see what we see. Market opened a little higher this morning than it closed yesterday and continued to drive down. So we see, for the record, the market is down 1.04%. When I say market, the S&P 500. Below the 2-day trend line, substantial downward pressure crossed over, originally going down on the 4-hour half-day chart on the 22nd. Now let's go back out to the 2-day chart, and let's go over to my favorite chart, the Qs, which is down 0.98%, about 1% today. What do we see going on the Qs? Well, it's a little different. It is just now on this 2-day candle, we see it breaking the 2-day trend line. It has broken that. We had a doji the day before, or the 2-day candle before. We talked about that actually yesterday, last night. And what we saw happening is whenever we see a doji, we know that that means uncertainty in the market. You can tell, though, that the bulls were able to drive the market up a substantial bit from where it was pushed down by the bears. And actually, it had driven up further, and the bears had driven it down. If you ask me, when I looked at that candle with a large wick on top, I would say that the bears had outperformed the bulls, and that was shown today when the market was pushed down even further in the NASDAQ 100. That's what the Qs is. Derivative oscillator is off. The blue and red MACD lines are coming together, but nowhere near as close as the total market or the S&P 500. Now let's drop back to the 4-hour chart and see what we see. The half-day chart shows us the market was a little up in the morning and down in the afternoon, just now piercing the 2-day trend line. And when we look at the 4-hour chart, we see it crossed over going down during the afternoon of the 22nd of July. And the derivative oscillator and the MACD are in down moves. But again, we don't have a confirmed down move yet on the big wave that we use. That is the 2-day chart. We'll have to see how everything plays out when the markets open on Monday, and whether or not there's going to be a confirmed down move in the NASDAQ 100, which of course represents what? Tech stocks. Now, lastly, what do? We always go and take a look at gold. What is gold doing? Well, gold is technically up 0.98% for the day. Now, we are using our 2-day candles, and what do we see? Well, it looks again, as we talked about yesterday, it looks like gold could possibly be bottoming out around 104.35. What does that mean? Well, we've seen gold hit over the last 2-day candles, so for 4 days, it's been hitting that same bottom, ending up there. Let's see if that holds. We saw the same thing try to happen, somewhere earlier in the charts. We've seen it happen a couple of times where the charts hung around for a couple of 3 days. Well, yes, about 6 days, somewhere around the 112.27, and it did not hold there. It dropped on down. Let's range back a little bit. One thing that's always fun to do when you see the market holding somewhere is to look and see if you can find any point where it held that earlier. And honestly, gold has not been this low as we ranged out in our charts for quite a while, and we really don't see anything back in time, anytime in the last year or so, where gold has been this low and has held it. So we'll just continue to watch gold and see. Let's look at the intraday action by going to the 4-hour chart, and we can see from the 4-hour chart, gold lost a lot in the morning and then gained some back during the day to end again up about 1%, just about 1%. Derivative oscillator lost a lot of its steam. Looks like the 4-hour chart is attempting, we see a converging, not a crossing yet on the 4-hour MACD, but that could be happening soon. So let's watch for that. We are below Of course, the 2-day trend line, we're nowhere near that right now as far as crossing goes, but it'll be interesting to see if the MACD does cross. So where does that leave us on everything? Well, it leaves us gold, still in a confirmed down move, could be bottoming out. IYY, down moves. We are waiting to see if it crosses, which is getting very close to crossing on the MACD on the 2-day chart. SPY, again, not as close as the total market, but getting close to crossing over, going down. Going to see if it's going to bounce around. It could, but it could continue to move down. Let's just watch how the week opens. And again, the Qs, not nearly as much volatility and not nearly as much downward pressure as we saw on the S&P 500 in the total market. That's where we are. Hope that this helps you as you get ready to start your week. Pay attention to these markets. Remember, a lot of thin trading, a lot of light volume in the summertime. Pay attention to what's going on. Make smart, intelligent decisions as you do your virtual trades. We wish you the best. Thank you so much for joining us at chartingwealth.com. Please be sure to follow us on Facebook and Twitter. We're also on Instagram now. Sign up for our newsletter at the website chartingwealth.com. Thank you so much for being with us. We wish you the best in your investing.